Hi, Andrew. Thanks for jumping on our podcast again today. It's the second time you've been on, so I appreciate you coming through.
Back again.
Yeah, hopefully, business is busy at the moment then for you.
Yeah, to be honest, I don't know what's happened in the last few months, but there's been a lot of activity, particularly around self-managed super funds and trusts, to be honest.
Awesome.
And yeah, it's just picking up.
Well, it's because of your content. That's, I think, I see you releasing content every week. Do you have like
Three times a week.
3 times a week?
Yep.
Wow. Okay. Nice. Well, that's what I aspire to. So hopefully we'll be able to get some videos from this and you can use that as well. But look, I really wanted to get on because I get asked a super common question I get asked about, investing in property and buying property is, Keaton, can I use my super can I use my super as a deposit to buy a property? And the common answer that I give a lot of my clients who ask if they can use super for, their superannuation savings for their deposit on a house is there's one super saver scheme, which basically is not necessarily using your employer's contributions, but it's you saving and using your super as sort of like a tool to save for that deposit. And then the other common one is a lot of people did take out funds during COVID and, now they don't need those funds anymore. They've got a job and it's no longer hardship. And, people have been able to save up that way, but that's sort of done and dusted. That's all gone now. And then the third option, which I really wanted to get your insight on, was self-managed super funds. You said you're seeing a lot of those today.
Yeah, there's been a definite uptick in the interest in self-managed super funds. And I think it's because people are seeing that there is another way or another avenue to sort of acquire property using your super savings to then buy a property. So there are a lot of complexities though with the superannuation system.
Is there, because look, self-managed super fund, I guess the first question that I ask you is what are the benefits of having a self-managed super fund? Just generally, what are the benefits of having that as opposed to an industry super fund where you have professionals doing the job for you?
So the main difference is flexibility in the type of investments that you want to undertake. If you have an industry fund, usually they have like different statuses, like low, medium risk, high risk, and then you just basically select which type of strategy aligns with what you want to do. And then the super fund, the industry super fund, will then go off and then make the investments based on the risk allocation that you basically appoint. That doesn't give you a great amount of flexibility because basically your cash is just given to them. They will go off and do it. And, it could work, it could not work. So you haven't really got that control. Yeah. The difference with the self-managed super fund is once you have the cash sitting within your self-managed super fund, you can actually use it and allocate the investments as you please. So this is where people go down the path of property acquisition. They go down the path of share trading, physical assets like gold and silver. So they have a lot more control on where they want to put their money for their investment.
And this is sort of to cover the obvious. This is about retirement, basically. What you're wanting to do is build enough wealth up in your self-managed super fund so that you don't have to rely on a government pension come retiring age. Is that right?
100%. And like for us, for our age group as well, there will be no pension by the time we get to 70. So the superannuation system was firstly designed so the government doesn't have to pay pensions. So back, I think it was like in the early 90s, they basically said to all employers they need to put a portion of your total income towards your super fund to basically fund your retirement because the government is not going to be paying pensions. So for us, it's a no-brainer. Like it's definitely for our retirement. Yeah.
Is the government not paying pensions? Is that something that I guess that could change, or is that set in stone that if you're 20 to 30 now, or younger, you're not going to have a pension at retirement?
That's correct. So I think they're tweaking with it at the moment, but basically, I'm in mid-30s. I'm not going to qualify for the pension when I get there at the age of 67, or at the moment 67, but it'd probably go up to like 70, 75 in 40 years' time. So
now that could be quite scary. I mean, I've got a few sort of older customers that They've got some assets, but they do rely on the pension. And I know people personally and close to me that have relied on that pension as well, come retirement. So it's a scary thing to now sort of say, well, you're responsible for your own retirement. And I guess that's why you need to take steps now to make sure that you're setting up the right future for yourself.
100%. So it's all going to go back down to what you expect in terms of your weekly income. If you want to have a really lavish and lush lifestyle, then obviously you need to try and contribute more to super now to try and build up that nest egg over the next 30 or 40 years or whatever it is to then use when you get to that point.
Yeah, right. And you can contribute extra to your super. You don't have to just rely on the employer's, mandatory or compulsory super payments.
Yeah, so the way the contributions to super are classified, they call it concessional contributions and non-concessional contributions. So concessional contributions are what your employer puts into the fund. So say you're on 100 grand, your employer would put 11% of that into your super fund, which is $11,000. The non-contribution cap is at $27,500 at the moment. So as an individual, you can go put the difference between 27,500 and 11 in that example as an additional contribution to your super fund, and also get a tax deduction as well.
Yeah, okay. Now, is that a good idea to do that, to make those extra payments?
Oh, look, it all helps, like it's one of those questions where it's very open-ended. Just
very individual, I'd assume, as well.
Exactly. Like it depends where you are in your working life cycle. It depends how old you are, where you see yourself being in the next 40 years. There's a lot of variables. So it's a very, very personal type of question.
Yeah, right. Now, apologize. I need to sneeze. We'll cut that bit out. But I'm going to play devil's advocate here. And because I've got a lot of clients who get into SMSF. I'm a big advocate for it myself, personally. And I have a lot of clients who inquire about it. But I'm going to play devil's advocate, and I'm going to say there were some statistics that came out. I don't know how old they are now, maybe a few years ago, actually. And it'd be on the Smart Money website, the government Smart Money website. And they used to say the risks involved with setting up a self-managed super fund. And they say over a period of X amount of years, I don't have the statistic on me, but that self-managed super funds performed not as well as industry super funds. And so that would obviously be a consideration for a lot of people considering self-managed super funds. Like I was saying at the start, do we leave it to the professionals, the people who are watching the market every day, know what they're doing when it comes to invest your money? Or do we take that responsibility on ourselves and do that?
Look, it's all about how much risk you're willing to take. So if you have no idea about investing, you don't really pay too much attention to what's on TV and that type of stuff, they're probably best to leave it to the professionals. But if you want to go down the path of actually having a go, there's two ways of doing it. You can fully self-manage it yourself. So what I mean by that is the money that you have in your super fund, invest it whichever way you please, whether it's property, physical assets, shares, whatever you like. Or you can also approach a financial planner to also help you manage your self-managed super fund as well. So then that's more of a hybrid type of approach where it's your money. You can go to them as an external consultant to sort of give you direction and give you a bit of comfort around how much risk you're taking. But also when you do that as well, you're also taking away how much control you have, because then you're basically listening to someone tell you what to do, which is what you're basically doing now in the fund anyway.
It's interesting, though, that there are options. It's not you. Like I said, I sort of gave the two ends of the spectrum there. You either have professionals do it or you do it. But you're saying there's actually options. You can actually hybrid it and say, well, I can get a professional to still help me invest the funds, but I've got a lot more visibility over what's happening and how much money my fund's making and how it's performing over time.
100%, yeah. Like people with super don't really think about it. Like I know in my early 20s, I never thought about it, but that's probably the time where you need to start actually thinking about it, because the compounding gain that happens between, say, when you're in your 20s all the way to your 40s is what's going to determine, that maximum super balance at the end. It could be hundreds of thousands of dollars in difference that you're retiring just by starting to look at these things a bit earlier than stay waiting until you're 45 or 50.
I remember early on in my career, I was working at the bank and I had a financial planner give me a graph, and they said pretty much exactly what you're saying. When you start investing in your 20s, and it was like a line graph and it showed sort of a gradual growth, right? And it was up here, and that person in their 20s, they had sort of a nominal increase to their income and et cetera, et cetera. And then they had someone in their 40s
Yes.
starting to invest, and they were earning more income than that person in their 20s at the time, I guess. And they grew up a lot sort of sharper. Their sort of portfolio grew a lot sharper, but it didn't quite reach the point that 20-year-old who'd been investing over the last 40 years or whatever the time frame was getting at. So they were saying the earlier you start, the better it's going to be for you when it comes to retirement.
100%. And the thing is as well, people also need to be cautious that it is money for your retirement. So it is a long way before you see it. And making risky type of investments as well is probably not advisable. Just because if you go all in at 25 because you've got a balance in super, and you go in all in on a stock or on a crypto or something like that, and you lose it, you put yourself behind significantly because that cash is gone. Of course, the ATO will ask you questions as well, because the whole intention of you managing the fund is to make more money when you retire than you have now. But if you're losing it with stock market spikes, then it's probably not the right way to do it, and you're probably going to get into trouble.
Now, can I ask you a controversial question? What is your feeling about cryptocurrency and investing in crypto?
Look, it's a very new asset. It's a very new type of asset. So I think you just need to be very careful. There's thousands and thousands of coins out there, and we've seen what happened in the last 6 months, 8 months. With the FTX collapse and other big crypto firms starting to go down, that there's only really a few at the top that remain. So, look,
high risk, high reward.
High risk, high reward. And I watch Bitcoin all the time, and it's fluctuating very rapidly. Like it was 50,000 US about a month ago or so. Now it's sitting at 70, 72. It dropped like to 66 this morning. So it's very volatile.
Huge drops. Huge percentage drops and increases as well, right? So
if you've got the guts to go into it 100%, but you also need to be careful that if you do lose that money, it's going to cost you when you retire, because if you lose it now and you're going to see that cash in 40 years time, it's going to take you a long time to actually even get the amount that you lose initially.
Now, one of the big driving forces behind setting up a self-managed super fund, and this is sort of where my passion lies a little bit as well, is investing in property. So you set up a self-managed super fund to invest in property. Can you maybe dive a little bit deeper into how does that function? What's the process of setting up a self-managed super fund, investing in property? How does that work in the long term as creating a wealth for you at retirement?
100%. So what happens once you initially set up a fund, your funds will be rolled over from your current super fund into a bank account that's in the name of the self-managed super fund to start with. Then at that point, it's probably best to approach yourself or a broker to then work out how much you can borrow with how much cash you have. Also working out how much serviceability the loan has as well. So if you have a decent amount, the broker will tell you can borrow X amount of dollars. Then at that point, you can go start searching for property, and the acquisition is very similar to buying property in your personal name, like in terms of the process. There are a few different things, like the interest rate may be a bit higher. You'll also need to set up, they call it a bear trust, to hold the property on behalf of the SMSF fund. And this is where it becomes complex and best to talk to an accountant to sort all that stuff out for you. But essentially, once you own that property, the rent will come in. It will cover the mortgage as well as the expenses. And any gaps should be funded by your employer's contribution into the fund as well. And on top of that, if you really want to, you can also add more contributions up to the cap of 27.5 to sort of make that loan work.
Right.
And basically, that property will be just like any other loan. It will just be paid off over time.
I think what I like about SMSFs, especially when it comes to investing too, is that you do away with a lot of the assessments that come under the National Credit Code. There's a lot of regulation around buying, an investment property in your personal name or buying your own occupied property, for that matter as well. And with the self-managed super fund, it is set up as a separate entity, right? With the trust and then the bare trust, as you were sort of saying. And with that separate entity, we can sort of almost quarantine the financials and the income from that and the expenses and the outgoings from that. So just because you might not have that sort of serviceability in your personal name to invest, if you've got enough funds in your super and you've got a good job and it's paying good compulsory payments, or you're making concessional, non-concessional, payments into your super, you still can invest in your superannuation fund. Now, a question that I will get asked, and you probably get asked this as well, people who are nervous about buying property in a self-managed super fund, is that when you buy an investment property, if you default on the investment loan, because you are getting a loan from the bank or from a lender to buy that in most cases, then the bank is going to sell that property from underneath you, right? Well, not necessarily underneath you, but they'll take possession and exercise their rights as a mortgagee and sell that property and to get their money back. Now, the question that sort of arises is that if you filtered a lot of funds from your self-managed super fund into that property as a form of a deposit or contributions, and then you default for whatever reason, hardship, or there's events that happen in your life you don't have no control over, can the bank basically pull all those funds that you've saved up over a long period of time and sell it off with the property, and there's nothing left there for you?
So this is probably one of the key advantages of using an SMSF to purchase property. So just before I explain that, just to go back on your point about quarantining the loan, it's probably one of the biggest advantages is that the loans of the SMSF are in the name of the SMSF only. So it doesn't impact your personal borrowing capacity. So you can go buy properties in your SMSF and then, have the intention one day to buy a home for your family. Those loans for the SMSF are not looked at as part of your personal
overall
borrowing.
Financial position. Yeah,
exactly. So this is where it's offering an option to people to get into the property market without using their personal borrowing capacity.
Yeah, that is great. That is actually true, and that is a massive draw card to start investing. Now, you can't do that through an industry super fund. You might be able to elect for certain types of property investment, but the self-managed super or the industry super fund isn't going to be an owner of a property or land in that case, and it won't get the same capital growth as you would if you had a property under your self-managed super fund. Yeah, and that's absolutely true.
So then to answer the second part of your question about the quarantining of the loan, with SMSFs and the borrowers that fund SMSFs, they have a thing called a limited recourse borrowing arrangement. And what basically that means is, like you said, if you buy a property in your personal name, you default, the bank will come after everything to try and recoup their funds. Within an SMSF, the financier has taken on the risk with the fund. And basically, if you cannot pay that debt for that property, the bank can only foreclose on that property and not touch the rest of your super balance.
Okay. Wow. All right. So your super balance, again, to reuse the word, is almost quarantined from the actual property and the loan itself. And so they can't sort of recoup all the funds from that self-managed super fund and leave you with nothing at the end of the day.
That's correct. So this is why the SMSF loan providers charge a higher interest rate as well, generally, just to cover that risk, as well as using higher LVR requirements as well, just because they know the risks that are involved, and those type of arrangements happen, or the process to sell a property if somebody defaults happens like that. This is why it's set up on purpose.
That's interesting. It's very similar to like the US. There's a lot of US mortgage functions where you basically, if you can't afford the repayments on your home, you just drop the keys off at the bank and you walk away type of thing, because the bank that can't sort of go, they've got a lot of that limited recourse borrowing arrangements in the US.
Well, that's what caused the GFC. That's what caused the GFC in 2008, where a lot of people that couldn't afford their mortgages just handed back the keys, and the banks were stuck with all these bad loans. And then a lot of banks were stuck
and
with
bad
a lot
mortgages
of
at the time, or bad properties at the time too, because of the crash. So Yeah, that's interesting. So it is interesting that we do have lenders, considering the history of sort of that limited recourse arrangements, that we still have lenders who are willing to lend to that, and sort of still say, well, we can do that. But in Australia, the self-managed super fund really is the only avenue in which you can take advantage of that type of arrangement. Is that right?
That's correct. So the big banks sort of got out of this market. The big 4 or 5 banks got out in like
About 5 years ago,
2018,
yeah.
around 2018.
Yeah.
So now you're dealing with lenders, which are not the big 5, and they do their risk assessments as well. So if you're thinking to buy a property in your super fund in a regional remote town, like I don't know where, like central New South Wales, they probably won't loan to that. To that property, because they know the risk is really high and the chances of them getting repaid are really low, so they won't fund to those type of arrangements.
Gotcha. So their risk profile for these types of loans would be more strict, and that's what I've seen as well. And they don't have your lender's mortgage insurance options.
Yes.
Some lenders will have lower loan value ratios. Some lenders will go up to 80. Some lenders will just go 70. Some lenders will even go lower than that. And so it looks like they are putting into place, these lenders, a lot more protections than probably what occurred back in 2008 in America. So that's probably a good thing. Now, okay, let's say we want to start getting a self-managed super fund. Where do we start? How much money do we need to have? I think that's a good starting point, right? How much money in our self-managed super fund or in our industry super fund do we need to have for this to be viable?
Look, to be honest, again, this is a very personal question. Just because if you want to be able to have the control of the super fund, you probably want to start with whatever balance, like straight away, to be honest, just because you want to have that control, you want to have that flexibility to do things. And if you have money sitting in an industry super fund, then you can't really do that. So there is actually no limit on the minimum balance that's required to set up an SMSF to start with. But yes, there are establishment costs to actually set up the fund, to firstly get it up and running and going. The second part is each year that SMSF will also need financial statements, tax returns, and external audits. So there's a compliance fee that happens every year without fail, because otherwise the ATO will shut down the fund. So they're probably the 2 cost components.
Now, you said basically there's no sort of minimum. Now, going back to sort of investing in property and when it comes to different lenders and things like this, I do get a lot of feedback from both lenders, accountants, and financial planners that all give sort of that $200,000 figure. They'll sort of say, oh, look, start with $200,000. Really, we won't look at it if it's anything less than $200,000 starting point. Where does that come from? Why are they saying that?
I think over the last maybe 10 or 15 years, SMSFs were very expensive to set up. I think there wasn't many specialists in the area as well, so not many people did it. And for that reason, the fund, the cost to establish and comply was really expensive. But now you've got a lot of new entrants to the market that have come in. There's more people doing it. It's becoming a bit more mainstream. So it's becoming actually cheaper to set up these funds.
Right. Interesting. Yeah.
And what you can do as well is say you're a husband and wife, you can actually set up one fund between the two of you. So rather than having 2 separate industry super funds, you set up one fund, combine the 2 super balances into the one, and then you can use that as the vehicle going forward as well.
Yeah, right. Yeah, right. Okay, that's interesting. And so basically both of you are members to that self-managed super fund. Both of you are sort of beneficiaries as well. And then you're combining that so you can get more growth, I guess, at the end of the day.
More growth, and then so say husband and wife both can contribute up to $27,500. So all of a sudden now you've got that $56,000 of money potentially coming in. It just increases your serviceability and your borrowing capacity because you have more money coming in, basically.
Now, how many members can there be? Can we get our cousin and our friend and our dog and like where does it end? Like how many people can be a part of the self-managed super fund, or is it limited to sort of marital relationships? Or
no. So you can have up to 6 people. Okay. They don't have to be related, but very how should I say, unadvisable, because you may have people that you're not related to or friends and that type of stuff. We're talking about long-term 40, 50-year relationships. Hopefully, if you're married, you make it to the 40 or 50 years. Maybe you don't. But yeah, getting into business or getting into this with your friends or your cousins, it's a very long-term arrangement. So just be careful.
Especially when it's got to do with your retirement, right? And getting access to those funds. So, no, interesting. Now, with when it comes to investing in property, and we spoke about the limited recourse, and we spoke about sort of different lending requirements. You can invest not only in residential property. I think that's what a lot of people think about doing. They invest in not just residential investment property, but you can also invest in commercial property. Is that right?
Yes. Yeah, so you can basically any type of property you can invest as long as it's generating income. So it can be resi, it can be commercial, it could be a unit, it could be a warehouse, as long as it's generating income. So you won't be able to go buy land and land bank. So say you go out into the country and you buy 10 hectares. Unfortunately, you can't do that with a super fund because it's not generating an income.
Mm-hmm. What if you buy? I'm just throwing it out there. What if you buy farmland?
Look, it all goes back down to whether it's going to create a benefit for the members in the future. As long as it's generating money to support itself and money's coming in and it makes sense, then it should be okay. But it's a very specific example.
Now, I know you're talking about land bank and buying land that's not generating income. What if your intention is to, and I know lenders have certain policies that they generally won't do, they won't do construction loans under an SMSF. But is there a regulatory reason for that, or is that just a lender policy?
I think it goes back down to income. So at the point when you invest in this asset, so say you go buy a unit in Northwest, at that point in time, it's very clear that it's going to generate money, or it is generating money. So there is a connection between income and expense. If you're buying land and holding it, you could buy land and not develop it for 4 years or 2 years or whatever it is. There could be delays. So the time it's going to take for that property to generate income is what the government doesn't like. So this is why usually construction contracts don't fly with self-managed super funds. The asset needs to be generating income already.
Gotcha. I'm going to throw out another hypothetical too, and I think I know the answer to this, but I want to get your feedback. What if you want to run a business through your SMSF? If it's generating an income, can you do that? Can you run a trading business through your SMSF?
Unfortunately, you can't, and you can't. So with an SMSF, you can invest into private companies. That is allowed. There are a whole set of provisions that you have to follow. For example, the shares need to be valued every year. That type of stuff. You cannot be a director or shareholder of that business either. There are exceptions, but generally that's the rule. So,
that's something. I mean, you can invest in the shares of a company, and it can be a private company as well that you can invest in shares.
The rules are a lot stricter, but yes, you can.
There's a lot of sort of checks and balances, I assume.
So you could also go onto the stock market, ASX or the New York Stock Exchange. You could buy shares in Woolies or Coles or whatever. It's exactly the same concept. It's like you're investing with the intention to get a gain, and that's how it's usually done.
Now, what are the rules? And I think you know what I'm asking here, but what are the rules in relation to buying a property, it generating income, and it being arm's length? And what is the exception? And I'm going to say exception with inverted commas because I know it's not really an exception. But what's the exception with commercial property and it being owner-occupied or maybe at arm's length? And what's the rules around that?
Sure. So with residential property, you as the member or the trustee are never allowed to rent the property at all because it's residential. So you have to go to the open market, find a tenant that's willing to pay the rent and keep it completely at arm's length. So you can't have your friend in there, your cousin, someone you want to charge lower than market rate. The ATO will definitely catch on and you'll get into big trouble, probably suspend you from the fund and completely close it.
Right.
With commercial property, it's a bit different. Commercial property as a business owner, you're allowed to rent, say the SMSF fund buys a commercial office. As a business owner, you're allowed to rent that property. Your business is allowed to rent the property from your own super fund, provided it's at market rate and everything complies in terms of it's at market rate. There's no the discounts, like everything is done at basically at arm's length. then yes, you as the director of your business are allowed to rent the commercial office from your own super fund.
Now, obviously, you'd have to make sure that you're staying on top of the compliance there. You are paying market rent, and you're not, what if your business, I guess, comes to a point where they make a late payment, and there's technically a late payment fee in the rental agreement. Does that mean that the business will then have to pay the late payment fee? Would that be considered a discount, or not at arm's length if you sort of say, "I will waive it because it's my SMSF"?
100%. So whatever's in the lease agreement, it has to be followed. And what will happen when the fund each year will get audited by an external party that's not your accountant? They will go through all of this, and just to double check, they will see the rent. The lease agreement is there. Is the rent coming into the fund, complying with all of that type of stuff? And they'll probably pick up on it anyway.
Now, what's the benefit of that? What's the benefit of a commercial property being bought and then being rented out by your business? Because really the idea and the reason they have those checks and balances when it comes to residential property, you can't rent it out to yourself, is because they want it to be generating income, and they want it to be an arm's length, and it has to be sort of an external investment, because that's going to be your retirement at the end of the day. So it's almost a protection for you. Whereas with the business renting the commercial property, why is that different? Like, why can we do that?
I'm not too sure. That's just the way.
That's just the rules.
That's just the rules. So yeah, it's one of those rules a lot of people don't know about either. It does help business owners as well, in a sense that they will most likely own the asset at the end of it. So say you are a business owner and you're paying rent, you will just pay the rent and you'll have no benefit of that when you retire, because the rent will go to a different landlord. I think the whole way it's structured is, yes, you will pay rent to yourself, but the idea is that rent will then pay off the mortgage, and by the time you reach retirement, you'll have your business as well as a paid off property to eventually generate you more rent from someone else once you get to that point.
Gotcha.
I think that's generally the concept.
Yeah, that's right. Oh, that's fascinating. That you can do that with a company. Now I say company, but if you're a sole trader, can you rent? Can you rent from the SMSF?
100%. Like it's just like
as long as it's a trading business, and it's compliant that way.
Trading business, making money, profitable, and everything's at arm's length. And yes.
Okay. Now, how do we buy one investment? Or do you have to go somewhere? Running out of light.
The lights just went off.
Fair enough. So we buy one investment in our self-managed super fund. Now, savvy investors and property investors always looking for the next one, right? So you want to buy a property, then you want to buy the next one. What I see more regularly is that a lot of my customers who might have a few properties out in external trusts and companies and in their own personal names, but they'll have one property in their SMSF. Why do you think that is? What do people do that on purpose? They don't want to buy multiple properties. Is there barriers maybe to purchasing multiple properties in the SMSF? What's your thoughts on that?
It all comes down to serviceability. So the lender will come when you go to the application to see whether you can get the loan. If the fund is not generating enough money to afford a third, fourth, fifth mortgage, then you basically won't get the money to get the loan, and that's what sort of stops people.
Right. And it's the same thing for the SMSF, right? Is that but that's based on contributions to the SMSF, not so much the external income. I think one of the other things too is that, and correct me if I'm wrong, but you can't traditionally, if you want to buy an investment property, you pay down one of your other properties, you get a bit of equity, you pull out that equity, and then that equity then becomes your deposit, sort of in lieu of a cash deposit for your next investment. And then it's sort of rinse and repeat. And that's how you sort of build that sort of property portfolio. But with an SMSF, can you pull out the equity of
unfortunately, because of the way it's been set up with the Bear Trust as well as the SMSF, you're not able to draw down equity. And that's just the way it's been. The whole system's been set up. So you can't use the equity from one property, take it out to put the deposit for the next one. It's not possible within an SMSF.
And I think that's why a lot of people, they do sort of stop, because what would need to actually happen, you need to have that cash deposit again, and you need to sort of accrue, enough cash again to then be the deposit for property number two if you're buying a second property under the SMSF, and you can't just rely on the capital growth of the property that you've already got.
Exactly. So that's probably one of the limiting factors. But you can also contribute more into your super, like a post-tax contribution as well.
Yep. Up to that 27, is that right?
No. I think it's 110,000 per year.
Okay.
So there's two types. You've got non-concessional contributions and concessional contributions.
Yeah.
Concessional contributions are 27.5, and the non-concessional is 110 per year. So
right.
What that means, non-concessional basically means that it's after-tax dollars. So you've already paid tax on it. It's just cash sitting that you have somewhere in a bank account, and you're putting it into the fund. But obviously, once you put it into the fund, there's no tax on the money going in. However, it's going to be stuck in the fund until you retire. That's the only thing.
Yeah, okay. All right. And when can you get access to all of this? Like, you've done all the hard work over X amount of time, and now you're closing in on retirement. When can you access the funds?
Look, at the moment, it's around the 66, 67 mark at the moment. But, 40 years from now, things can change. So it's around about that, call it 70-ish mark. By the time we get there, that you'll be able to use the funds. Of course, the rules as well will most likely change from here to then.
Yeah.
But, hopefully not.
Yeah, fair enough. And I do know that again, during COVID, I mentioned this at the start of the call, during COVID, or at times of hardship, even without COVID, you can pull funds out of your super fund to sort of help you through time of hardship. Do you feel like the government sometimes, I'm asking you probably a political question here, but do you think the government sometimes will get people to fund their own, like during COVID, they sort of, rather than sort of giving a stimulus, they sort of said, this is our stimulus and we're just allowing you to take out your own funds from your own superannuation, which is obviously going to have an impact in the long run. What's your thoughts of that? Do you think that should have happened? Do you think it's okay to pull out funds from your self-managed from your super fund in general, come hardship, or do you think there should be more responsibilities from external parties, I guess?
Look, I think the hardship exemption is a very tough one now to sort of get through. Like you need to be an extreme hardship. Right. And what the ATO will do is they will look at each case on a single case basis. So they will take their time, they will do their assessment, and if they agree, say you have terminal cancer or something like that, then yes, they may approve it. COVID is one of those things where no one knew what was going on, and everyone just sort of, went to the extreme and basically gave everyone, I think it was 2 lots of $10,000 optional, provided that there was a material reduction in how much they were earning out of their normal earnings.
Yeah, untested. I'm pretty sure it was untested.
I think everyone at the time was freaking out, including the government, and they just approved it for whoever who applied. So I think unless something like that happens again, like that extreme, I don't think they're going to allow that to happen.
Right. Okay. All right. Maybe some lessons learned from that, you'd say, and they will probably not apply that same policy later on. I know
we're still paying for all of those, like that excess infusion of capital. We're paying for it now in inflation as well. Things are really expensive. The RBA is going to hold course. I think they're going to raise rates, to be honest, once more, just because there's so much money in the system. So they have to get it out.
It was interesting. It was interesting during COVID where after, I should say, where there was a lot of sort of stimulus as people were sort of losing work. And now it's a very individual and personal journey everyone had during COVID. And I can't speak for anyone, but I do know there's lots of occasions where a lot of businesses tried to help maintain employment, maintain business and keep it running. And then the government was also helping out with stimulus packages. But in all that, we're also at home doing nothing and spending no money on fuel and eating out and entertainment and things like this. And so we ended up just saving. And a lot of people I know had saved up a whole bunch of funds. And so as soon as COVID finished, there was a lot of spending. There was a lot of spending on property, a lot of spending just in general. And it was sort of like this perfect storm, right? Where there was just a lot of cash in the system and no one spent during COVID. And then all of a sudden it just skyrocketed with all the spending. I think that's been a massive contributor to inflation. Now, you said something. You said rates. You think rates may increase again? Is that what you said?
Yes. Yeah. Look.
Okay. Now that's not a common thought. A lot of people are thinking that rates are going to hold, and maybe I think it was the first quarter next financial year that rates might start to look to reduce again. So you're disagreeing with that?
Oh, look, I think everyone was sort of expecting rates to start getting cut in March. They just went March of this year, getting pushed out to June. I don't think, I think that's also what's caused the run up into the property market as well. A lot of people are saying, well, if I buy the property now at the rates that are there now, it's only going to get cheaper. So let me go overpay for a property. Let me buy it, because in 6 months' time, it's going to be cheaper for me to own that property. So that's what's, that's caused everything to sort of go up. I think the tensions that are going overseas, in terms of, you've got the wars that are going on, it's going to cause the price of oil to increase, which is a big contributing factor to inflation. So I think that's going to flow through. I think it will start in the US first, and then it will flow its way down to Australia. And everyone's saying they're going to cut rates, but how are they going to cut rates if unemployment's at near record lows? Like, it doesn't make sense, because it's just going to further fuel the fire.
Okay.
Interesting. So, yeah. I'm
Now
probably one of the only people that say it's going to go up, just because I think that they have to shock the system a bit. And if they don't do it now, it's going to cause more problems later, like in 2 or 3 years' time, when inflation is so entrenched that it's going to be too hard to put it back in the bag. So they have to do something.
Devastating news for a lot of people to hear, I'd say, if that came true. I think, though, you're right, where there's a lot of movement in So there's a lot of movement in property investing market, and if you look at property markets in Sydney, they've gone up in value. I think I saw an article just recently, maybe last week, that said they've gone up $250,000 in value in properties in sort of Western Sydney, and I'm thinking, how is that possible with rates as high as they are and people? And I also have a lot of customers who have pre-approvals to purchase properties, and properties that are being listed for $650,000 are selling for $780,000, at auction. And so there's so much demand in the market. There's so much demand still, and it is sort of it's a bit against the normal trend of things, because usually high interest rates mean reduced interest in the market. High interest rates mean reduced spending. And for some reason, we're not seeing that. And you think unemployment has a factor in that? Like, where are people getting these funds, and how are people spending when interest rates are so high? And we were talking about the mortgage cliff only last November. That sort of came and went, and everyone sort of forgot about this mortgage cliff that we all spoke about. So, what's happening?
The mortgage cliff, I think, is still there. So November was when everyone fell off cliff, apparently, with all the fixed rates going into variable. But you also need to remember that people have savings, especially all the COVID savings, as well as money just racked up. So it's going to take a bit of time for those savings to decrease. So what I think is going to happen is savings will start to decrease, and then credit card debt will start to go up. I think those two factors put together is then what's going to start to cause things to shake, because the credit card limits will go up. They're going to be high. There's high interest. It's going to get to a point where they're going to become unaffordable. So I think that's the point where the property market and the economy will start to really shake. So I still think I think it's going to happen towards the end of this year, to be honest.
Yeah. Okay.
But who knows? It's I wish I had a crystal ball, but that's just what I think is going to happen.
No, fair enough. It's a very interesting take, because it is sort of that. The common theme at the moment when people talk about rates is that, okay, well, we'll wait for the rate to decrease. And you're right, they're probably taking a few steps now with the expectation that rates will decrease, which is always a dangerous move to try and try and predict the rates. we always have people ask us, "Oh, Keaton, should we go on fixed or should I go on variable?" And basically I always bring them back to the discussion of features. I was like, look, in a loan, fixed rates usually have these features and variable rates have these features. If you're trying to if you're trying to gamble and game the system and try to figure out if fixed rate's going to be the best, there's no way. I can't predict the next 3 years, of rates. And they go, oh, but my friend, he got a fixed rate back early, and now he's on a really good fixed rate. And I'm like, your friend didn't know. Your friend guessed.
He just got lucky.
Yeah, your friend guessed that he got lucky, and he's probably telling everyone he knew it was happening. But at the end of the day, we all guess, and so look at the features rather than that. Now, look, I'm grateful for you to jumping on. Is there anything else that you'd want to add that you feel like listeners or anyone could benefit from in relation to the self-managed super fund? We've covered sort of why it's important, a little bit about the process, so some risks involved with it. Is there anything else that you'd like to cover?
I think just let everyone know that if you're going to go down the path of an SMSF, to probably find someone who does it daily, who specializes in it, because not all accountants or tax advisors actually set up funds. So make sure if you go to someone, they know what they're doing before you enter any type of product.
Yeah, go to Andrew Romano.
Yeah. Come see me.
No, thanks, Steve, for having a chat with me today about it, and we'll let you go, but I appreciate you coming on and sharing your insight with everyone.
Perfect. I'll see you soon. See you again.